Disclaimer.
You've played musical chairs before? You know that moment. The music cuts out, everyone scrambles, and most people find a seat. Crisis averted, right? Game over? Well, here's what nobody tells you about that game. The players who didn't sit down, they didn't go home. They're still standing in that room, catching their breath, eyes already scanning for the next round. And here's the part that should make you lean in a little closer. The next round has fewer chairs. That's exactly what just happened in the silver market. And if you've never paid close attention to commodities before, I want you to stick with me here. Because what's unfolding right now connects directly to your savings, your portfolio, and the purchasing power sitting in your wallet. Let's start with what the mainstream financial press called a silver rally this week. Headlines cheered, traders exhaled, and on the surface, it looked like a tense situation had quietly resolved itself. But when you actually pull the data, and I mean the raw CME numbers, not the sanitized summary, a completely different story emerges. Not a resolution, a migration. The pressure didn't leave the silver market. It changed its address. Here's what that actually looked like in real time. Coming into late February, the March silver contract on COMEX was carrying what's called open interest, essentially the total number of outstanding contracts where someone has promised to buy or deliver actual physical silver. That open interest in March was sitting at 268 million ounces, a staggering number. And then, in just 6 trading sessions, it collapsed down to roughly 52 million ounces. That's an 80% drain in less than 2 weeks. If you watched only that number, you'd think the fire was out. But here's where it gets interesting. While March was shedding those contracts, the May silver contract was simultaneously absorbing them, not losing interest, gaining it. By February 26th, May open interest had climbed to 379 million ounces. Think about that for a second. The institutional money, the hedge funds, the sophisticated players who understand this market at a granular level, they didn't close their positions. They rolled them forward. They moved their chips from one square to the next. Same bet, new date. Pop quiz, why would a professional trader do that? If you genuinely believed March's tightness was a temporary blip, you'd take your profits, close the contract, and walk away. You wouldn't pay the cost of rolling a position forward into the next month. The only reason you roll is if you believe the situation in May will be at least as compelling, or more so, than what you were seeing in March. These traders, managing billions of dollars, are making a very public, very expensive bet that the vault problem gets worse before it gets better. And what is the vault problem exactly? This is where our story gets its teeth. On the same day those 379 million ounces of May contracts were sitting on the books, the COMEX registered silver vault, the physical metal that actually backs potential delivery obligations, held exactly 87.17 million ounces. That number comes straight from the CME Group's own vault report, published February 26, 2026. Not an estimate, not a projection. The official audited figure. Now, I want you to hold those two numbers next to each other for a moment. 379 million ounces of delivery promises, sitting on top of 87 million ounces of actual silver. That's a ratio of more than 4 to 1. If you've ever had 4 people show up to a dinner party when you only cooked for 1, you understand the basic problem here. But the vault number is actually more alarming than it first appears, because it isn't static, and it isn't holding steady. Since October of 2025, the COMEX registered silver vault has drained by 47%. Nearly half of the metal that was sitting there just 4 months ago is gone. Not relocated to the eligible category, not transferred between custodians, gone from registered, meaning gone from the pool of metal that can legally fulfill a delivery contract. And on that same February 26th session, despite an active trading day with real volume moving, the CME reported 0 net inflow to the registered vault. No new silver arrived to replace what's been drawn down. Let me put this in perspective with a scenario you might actually relate to. Imagine you run a local hardware store and you've made written commitments to sell 379 lawnmowers to customers who are all planning to pick them up in May. Right now, your warehouse holds 87 lawnmowers. Your supplier, we'll get into exactly why in the next chapter, has gone effectively dark, and your warehouse stock has been falling by about 785 units every single day. Your May pickup date is 10 weeks away. Do you feel like the crisis passed, or do you feel like the calendar just became your enemy? The drain rate isn't speculative. Multiple sourced reports from February 2026 confirm an average registered vault outflow running at approximately 785,000 ounces per day. At that pace, with no new metal arriving, the math writes itself. By the time May's first notice day arrives in late April, the 87 million ounce vault could be looking at somewhere between 63 and 67 million ounces. The delivery obligations, meanwhile, remain at 379 million ounces and counting. Have you noticed something interesting about how this story has been covered? Or rather, how it hasn't been? The financial media loves a silver rally headline. Silver surges on industrial demand. precious metals find footing, what they're not explaining is the structural arithmetic underneath the rally. The mechanism by which a massive overhang of paper promises is now stalking a shrinking pool of physical metal toward a very specific calendar date. Here's what should genuinely grab our attention. The institutional players who rolled from March to May aren't doing this blindly. These aren't retail investors clicking buy on a trading app during lunch. These are firms with dedicated analysts, vault access, delivery infrastructure, and direct lines into the warehouses. They know what's in those vaults. They can see the drain rate. And they chose to stay in the game, increase their exposure, and move their target date forward. That's not speculation, that's a signal. What if I told you that the story of March's resolution is actually just Act 1 of a 3-act play? Act 1, pressure builds, most contracts roll or close, mainstream media calls it a victory. Act 2, which is where we are right now, the rolled contracts pile onto a shrinking vault, 3 independent supply crises converge simultaneously, and the math gets quietly, steadily worse. Act 3 starts at the end of April. And, unlike a movie, nobody knows exactly how this one ends. Think about this scenario. You have your retirement savings partially in a silver ETF, or maybe you've been watching silver as a hedge against inflation while grocery prices keep climbing. You look at the price today and it seems like things are moving in a reasonable direction. But the price you see on your screen reflects the paper market, the traded contracts, the futures, the derivatives. It does not necessarily reflect what someone would actually pay you for a bar of physical silver sitting in a dealer's case right now. The gap between paper price and physical price has been quietly, steadily widening. And the May delivery window is the moment when the market is forced to reconcile those two realities. We're going to walk through exactly how this convergence is being accelerated by forces most analysts aren't connecting. A collapsed supply chain in Mexico, a secret industrial buying spree by 2 of the world's largest technology companies, and a physical silver shortage in Shanghai that's defying every normal market mechanism that should have already fixed it. 3 independent pressure points, all arriving at the same moment, all pointing toward the same month. The musical chairs game isn't over. The players are catching their breath. May is the next round. And right now, the count of chairs and the count of players don't come close to matching. Picture a pipeline, not a metaphorical one. An actual network of roads, trucks, and heavily armed escorts moving raw silver ore out of the mountains of western Mexico and into the global supply chain. That pipeline feeds roughly 20% of the world's annual silver production. It has operated, with occasional disruptions, for decades, and right now, as of February 2026, it is effectively severed. Here's what happened and why it matters directly to our story. In February 2026, Mexican authorities confirmed the killing of El Mencho, the leader of the Jalisco New Generation Cartel, known as CJNG, one of the most powerful criminal organizations in the Western Hemisphere. On the surface, you might read that as a law enforcement victory. And in some narrow sense, it was. But anyone who understands how cartel power structures operate in resource-rich regions knows that removing the top figure doesn't restore order. It triggers a succession war. Territory gets contested, alliances fracture, and the immediate practical result on the ground was a wave of highway blockades across Jalisco and Sinaloa, the 2 Mexican states that sit directly on top of some of the world's most productive silver-bearing geology. Those aren't just inconvenient traffic delays. Those are the roads that mining company vehicles use to move equipment in and personnel out. According to reporting from Pinnacle Digest, and corroborated by Clive Thompson's February 2026 analysis, geologists and engineers are now actively refusing deployment into those regions, not because the mines are damaged, not because the silver stopped being in the ground, but because the security situation has made the human cost of extraction unpredictable in ways that no insurance policy adequately covers. You can rebuild a flooded shaft. You cannot easily replace a specialized mining engineer who decides the risk isn't worth the paycheck. What does that mean for the timeline? This is the part that most commodity coverage glosses over with a phrase like temporary supply disruption. Recovery from a cartel succession conflict in a major mining corridor isn't measured in weeks. It's measured in years. The infrastructure has to be resecured, labor has to be re-recruited, trust between local communities and mining operations has to be reestablished. The silver sitting under those mountains isn't going anywhere, but getting it out, processed, and into the global supply chain is now a fundamentally different calculation than it was 3 months ago. So that's one island, North America's primary silver source, quietly going offline just as the COMEX vault is draining at 785,000 ounces a day. But here's where it gets interesting, because the supply side of this story has a second layer that most people haven't heard at all. While Mexican silver production was being disrupted by cartel instability, 2 of the most sophisticated industrial consumers of silver on the planet were quietly making moves that should have been front-page financial news. In January 2026, Samsung executed a direct prepayment deal with La Paria, a productive Mexican silver mine, locking up 100% of that mine's output for the next 2 years. The deal was reported by Trading Key and has since been corroborated through industry channels. Read that again carefully. 100% of output locked for 2 years, paid up front. Samsung isn't buying silver on the spot market anymore, at least not from that source. They went directly to the mine, bypassed every intermediary, and took the metal off the table before it could reach any exchange. And Samsung wasn't alone. According to multiple sourced reports from early 2026, Tesla reportedly assembled approximately 85 million ounces of physical silver through private off-market channels. To put that number in context, 85 million ounces is essentially the entire current COMEX registered vault. Tesla didn't touch COMEX to do it. They didn't file visible futures contracts. They went into private channels, found physical metal, and moved it off the publicly visible market entirely. Now think about what that tells you, because this is a signal that should cut right through the noise. Samsung and Tesla are not precious metal speculators. They are engineers and manufacturers who need silver to build products, solar panels, EV battery management systems, semiconductor components, screens. When companies like that stop buying through normal market channels and start executing secretive, multi-year, prepaid lockup deals directly with mines, they are telling you something with their checkbooks that they would never say in a press release. They believe the publicly available supply of silver is going to get significantly harder to access, and they are paying a premium today to guarantee they won't be competing for it tomorrow. Neither of these deals touched COMEX. That's the critical detail. The most sophisticated industrial buyers in the world, the ones with the research budgets, the supply chain analysts, and the direct relationships with miners, are quietly exiting the paper system. They're not shorting silver futures. They're not even buying silver ETFs. They're going around the exchange entirely, directly to the physical metal, and locking it away. What's left on COMEX is a shrinking pool being chased by a growing mountain of paper contracts. That's the second island. Now let's cross the Pacific. Shanghai's physical silver market reopened after the Lunar New Year holiday in February 2026, and what happened in those first sessions confirmed what supply chain analysts had been quietly tracking for months. Institutional buying on the Shanghai Futures Exchange accelerated across 2 consecutive sessions, even as SHFE silver inventories were already sitting at 10-year lows. Chinese industrial demand for silver, driven by an absolutely relentless build-out of solar panel manufacturing, electric vehicle production, and consumer electronics, did not pause for the holiday. If anything, the post-holiday reopening came with pent-up demand that hit an already thin market like a wave hitting a narrow harbor. Here's the number that should make you stop scrolling. Physical silver in China is currently trading at a persistent premium of $7 to $10 above Western spot prices. In a normally functioning global commodity market, that premium would be self-correcting within hours. Traders would buy silver cheaply in New York, ship it to Shanghai, sell it at the premium, and pocket the difference. Arbitrage is the market's immune system. It finds imbalances and eliminates them automatically. But that spread hasn't closed. It has persisted, week after week, because the physical metal cannot move fast enough across the supply chain to satisfy the demand differential. The arbitrage mechanism that keeps global prices aligned has effectively broken down. What you're witnessing is something that commodity markets almost never experience: genuine regional fragmentation. The global silver market has quietly split into 3 isolated pockets: Asia, North America, and Europe, each one hoarding whatever physical metal it already controls because the pipelines between them can no longer move supply fast enough to balance prices. Asia is running hot with industrial demand and thin inventories. North America's primary supply source is compromised, and its exchange vault is draining daily. Europe is watching both situations nervously and accumulating where it can. This is what I mean by the 3 islands. In a healthy market, these regions are connected. Metal flows toward the highest price, premiums compress, and a single global spot price reflects actual supply and demand. That system is not functioning right now. The islands are isolated, and isolated markets don't gradually drift apart. They diverge sharply until something forces a reconciliation. Have you ever watched what happens when you try to connect 2 containers of water at very different levels? The moment the valve opens, it isn't a slow trickle. It's a rush. The system wants to equalize fast. That's exactly the dynamic building in the silver market right now, except the valve is the COMEX May delivery window at the end of April. When that window opens and holders of 379 million ounces of contracts show up asking for physical metal, the exchange cannot quietly manage the imbalance through normal market mechanisms anymore. The 3 islands will be forced to communicate, and the price signal that emerges from that conversation will reflect the reality of physical scarcity. not the comfortable fiction of paper abundance. One more piece of this puzzle deserves your attention, because it connects directly to something you may have experienced personally if you've ever tried to buy physical silver from a dealer. In January 2026, during a period when the COMEX spot price was experiencing a sharp pullback, dealer premiums on physical silver, the markup you pay above spot to actually hold a coin or bar in your hand, were running at 30 to 40% above the paper price. At the same time, PSLV, the Sprott Physical Silver Trust, which holds audited, allocated physical silver in a vault, was trading at an 11.6% discount to its own net asset value, meaning you could buy a share of a trust that holds real, verified, allocated silver for 11 cents, less per dollar of metal than the metal was actually worth. That is not a normal market condition. That is a market under stress, mispricing assets in ways that reflect confusion and structural strain rather than rational price discovery. The gap between what paper says silver is worth and what physical silver actually costs in the real world isn't theoretical anymore. It's measurable, documented, and widening. Three converging forces, a severed Mexican supply corridor, the world's most sophisticated industrial buyers, quietly exiting the exchange system, and a fragmented global market that can no longer self-correct through arbitrage, are all accelerating the same outcome at the same time. May's delivery window doesn't create this problem. It reveals it. And what happens when a market is forced to reveal the truth it's been quietly hiding? That's where our story goes next. Let's do the math together. Not the complicated kind. The kind that requires nothing more than a calculator and the willingness to look at numbers the financial press isn't putting side by side for you. We know the COMEX registered silver vault held 87.19 million ounces on February 26, 2026. We know the confirmed drain rate running through February averages approximately 785,000 ounces per day. And we know that on that same February 26th session, with active trading volume on the books, the net inflow to the registered vault was zero. No new silver arrived. The outflow continued and nothing replaced it. Now count forward to April the 28th. That is May's first notice day, the date when holders of May futures contracts can formally submit their intention to take physical delivery. Between February 26th and April 28th, there are approximately 40 trading sessions. Multiply 40 sessions by 785,000 ounces per day, and you get roughly 31.4 million ounces drained from the vault before May's delivery clock even starts ticking. Subtract that from today's 87.17 million. And you're looking at a projected registered vault somewhere between 63 and 67 million ounces by the time first notice day arrives, assuming the drain rate holds, assuming no miracle inflow materializes, and assuming no additional large withdrawals accelerate the pace. Now set that number next to May's open interest. 379 million ounces of outstanding delivery obligations sitting on top of a vault that will likely hold 63 to 67 million ounces. That's a coverage ratio of roughly 6 to 1. 6 ounces of promises for every 1 ounce of deliverable metal. To put that in human terms, imagine a bank that has made loan commitments totaling 6 times its actual cash reserves, with no new deposits expected, and the vault door showing a slow, steady leak. The word for that situation isn't manageable. The word is insolvent, and the only question is timing. Here's what should genuinely concern us. March's situation, which the market treated as a near crisis requiring urgent management, never reached a ratio this severe. The May setup is structurally worse by every measurable metric. Higher open interest, lower projected vault, confirmed supply disruptions that weren't present 2 months ago, and 3 isolated regional markets that can no longer redistribute metal fast enough to plug the gap. March was a dress rehearsal. May is the performance. But there's a mechanism built into the COMEX rulebook that the exchange can reach for if physical delivery becomes mathematically impossible. And understanding it requires a detour to London in March of 2022. Because what happened there is the closest historical parallel we have to what's building in silver right now. Nickel. Of all the metals that could have broken the London Metal Exchange, most traders would never have predicted nickel. But in March 2022, as Russia's invasion of Ukraine disrupted global commodity flows, and a major Chinese producer found itself catastrophically short-squeezed, the nickel price did something extraordinary. It doubled in a single day, then it doubled again. Within 48 hours, the LME nickel price had risen by more than 250%, with contracts trading above $100,000 per metric ton, a level that had no relationship to physical reality, because the physical market never reflected those numbers. The LME's response was unprecedented in modern commodity exchange history. The exchange halted nickel trading entirely. It canceled billions of dollars worth of already executed trades. Contracts that had been legally agreed upon, confirmed, and cleared were retroactively voided. And when trading eventually resumed, the exchange imposed artificial price caps that kept the paper price disconnected from where a free market would have taken it. In one decisive intervention, The LME protected its largest short holder from catastrophic losses, and in doing so, permanently shattered its credibility as a trustworthy price discovery venue for nickel. Trading volumes on LME nickel never fully recovered. The market migrated. Trust, once broken at an exchange level, is extraordinarily difficult to rebuild. COMEX has its own version of that escape valve. It's called Rule 589, and it gives the exchange the legal authority to force cash settlement, paying out dollars instead of delivering physical metal when physical delivery becomes operationally impossible. The rule exists for a reason. Commodity exchanges are not designed to be the last resort guarantor of every ounce of metal their contracts represent. They're designed to facilitate price discovery and risk transfer. But when the gap between paper obligations and physical reality becomes wide enough, Rule 589 is the mechanism that lets the exchange step back from the edge. What are the three structural conditions that triggered the LME nickel intervention? First, open interest dramatically exceeding physically deliverable supply. Second, a concentrated short position unable to source physical metal to cover. Third, a supply disruption creating genuine doubt about near-term availability. Check those conditions against the May silver setup. Open interest at 379 million ounces against a projected vault of 63 to 67 million ounces. Condition 1 is not approaching, it has already arrived. The supply disruption in Mexico is confirmed and deepening. Condition 3 is active. The short side of the silver market, which includes both commercial hedgers and speculative traders who have sold contracts they cannot cover with physical metal, is staring at those same vault numbers every morning. Condition 2 is building daily. This is not a prediction that COMEX will invoke Rule 589. It's a recognition that the same architecture of stress that forced the LME's hand in 2022 is assembling itself again, in a different metal, on a different exchange, with a specific calendar deadline. The critical question, and this is the one worth watching every single day between now and late April, is whether May open interest begins collapsing the way March did before first notice day arrives. If May OI starts declining sharply through mid-April, it means participants are rolling or closing positions voluntarily, and the stress dissipates without a forced resolution. But if May OI remains elevated into the final 2 weeks of April, the delivery arithmetic has no clean exit. Either a vault miracle occurs, Mexico recovers faster than anyone expects, massive new inflows materialize from somewhere, or the exchange faces a delivery impossibility that Rule 589 was written to address. Watch the May open interest number. It is the single most important data point in the silver market between now and the end of April. Now here's the conclusion that ties everything together, and it's one that directly affects how you think about any silver position you hold or are considering. There are currently 2 silver markets operating simultaneously, and most people only know about one of them. The first market is the one you can see, the COMEX paper price, the ETF quotes on your brokerage screen, the futures charts on financial websites. This is the price the mainstream financial media reports when it says silver is trading at whatever number flashes on the ticker. It is determined by the buying and selling of contracts, most of which will never result in physical delivery, most of which represent promises rather than metal. The second market is the one operating in the background. Dealer premiums running 30 to 40% above spot during stress periods, physical silver in China trading $7 to $10 above Western quotes, PSLV shares selling at an 11.6% discount to their own audited metal value, Samsung and Tesla bypassing exchanges entirely to lock up physical supply through private multi-year deals. This market is determined by the actual availability of metal you can touch, store, and hold, and right now it is telling a dramatically different story than the paper price. These 2 markets have coexisted in a state of managed tension for years, but May's delivery window is a moment of forced reconciliation. When 379 million ounces of contracts arrive at a vault holding a fraction of that in physical metal, the exchange must either produce the metal, invoke cash settlement, or watch participants scramble in ways that make March look like a calm afternoon. And here's the historical pattern that every commodity crisis has confirmed. From the Hunt brothers' silver squeeze of 1980 to the LME nickel crisis of 2022, when paper prices and physical prices are forced to reconcile, it is the paper price that moves toward physical reality, not the other way around. The physical market is the ground truth. The paper market is the map. And when the map and the terrain disagree this severely, you trust the terrain. What does this mean for you? If you hold silver through an ETF, understand the difference between a fund that holds allocated physical metal, like PSLV with its audited vault, and a fund that holds futures contracts or unallocated positions that could be cash settled in a Rule 589 scenario. Those are not the same instrument, and in a stress event, they will not behave the same way. If you're watching silver as an inflation hedge while our grocery bills and energy costs keep climbing, understand that the price on your screen may be significantly understating what physical silver would actually cost you today. in the real market. And if you're simply trying to understand what's happening to our financial system, this story is a window into a structural reality that applies far beyond one commodity on one exchange. The music is still playing, but the chairs are being removed one by one every single day between now and late April. April 28th through 30th is the moment the music stops again. And this time, the math has already told us how many chairs will be left. The question isn't whether the gap between 379 million ounces of promises and 63 million ounces of metal gets resolved. It will be resolved. Markets always find resolution, one way or another. The question is how it gets resolved, and whether you understood what was happening before or after that resolution arrived. You now know. What you do with that knowledge is entirely up to you.